Welcome to our comprehensive guide on exchange-traded fund (ETF) investing, a popular and diversified approach to investing. In this video, we will walk you through the basics of ETFs, the benefits of investing in them, and strategies to consider for maximizing returns. Whether you're a seasoned investor or a beginner, this video will provide valuable insights into why ETFs have become a go-to choice for many investors. What are ETFs? ETFs, or exchange-traded funds, are investment funds that pool money from many investors to purchase a diversified portfolio of assets such as stocks, bonds, or commodities. Unlike mutual funds, ETFs trade on stock exchanges, allowing investors to buy and sell them throughout the trading day. This flexibility, combined with their inherent diversification, makes ETFs an attractive option for those seeking exposure to various asset classes. Types of ETFs. There are various types of ETFs designed to meet different investment goals. Some of the most common types include stock ETFs. These ETFs invest in a basket of stocks and are designed to track a specific index, such as the S&P 500. Stock ETFs allow investors to gain exposure to a broad range of companies or sectors without purchasing individual stocks. Bond ETFs. These ETFs invest in fixed income securities, such as government or corporate bonds. Bond ETFs are popular among investors seeking steady income and a lower level of risk compared to stock ETFs. Sector and industry ETFs. These ETFs focus on specific sectors, such as technology, healthcare, or energy. Sector ETFs allow investors to gain targeted exposure to industries they believe will outperform the broader market. Commodity ETFs. These ETFs track the price of physical commodities like gold, oil, or agricultural products. They provide a way for investors to participate in commodity markets without physically owning the commodity itself. International ETFs. These ETFs invest in companies located outside of the investor's home country. International ETFs offer an easy way to diversify geographically and gain exposure to global markets. Thematic ETFs. These focus on specific investment themes or trends, such as renewable energy, robotics, or artificial intelligence. Thematic ETFs are attractive for investors who want to invest in long-term growth trends. How ETFs work. When you invest in an ETF, you are essentially buying shares of the fund, which in turn owns the underlying assets. The price of an ETF share fluctuates throughout the trading day based on the market value of its underlying assets. Most ETFs track an index, such as the S&P 500, by holding a representative sample of the assets in that index. This passive management approach keeps fees low, making ETFs a cost-effective investment option. Benefits of ETF investing. Diversification. ETFs provide instant diversification by holding a basket of assets. This reduces the risk associated with investing in a single stock or bond. Even if one stock in the ETF underperforms, gains from other holdings can offset those losses. Liquidity. Because ETFs trade like stocks on exchanges, they offer high liquidity. Investors can buy or sell shares throughout the day at market prices, making it easy to react to market changes or take advantage of short-term opportunities. Lower costs. ETFs generally have lower expense ratios compared to mutual funds because they are passively managed. Investors can also avoid high management fees associated with actively managed funds. Transparency. Most ETFs disclose their holdings daily, which means investors can see exactly what they are investing in. This level of transparency helps build trust and allows for better-informed investment decisions. Tax efficiency. ETFs are typically more tax efficient than mutual funds. The unique structure of ETFs minimizes capital gains distributions, which means investors may face fewer tax liabilities when compared to other types of investments. Strategies for investing in ETFs. Core and satellite strategy. In this strategy, investors use ETFs as the core of their portfolio, representing the majority of their investments in broad-based index funds. The satellite portion consists of individual stocks, bonds, or thematic ETFs that add exposure to specific sectors or trends. This strategy helps balance risk and growth potential. Dollar cost averaging. This involves investing a fixed amount of money into an ETF at regular intervals, regardless of the ETF's price. By doing so, you can reduce the impact of market volatility and avoid trying to time the market. Asset allocation, properly allocating your investments across different asset classes, such as stocks, bonds, and commodities, can help reduce risk. ETFs make asset allocation easier since they provide exposure to various asset classes through a single investment. Rebalancing, over time, your investment portfolio can become unbalanced as certain assets perform better than others. Regular rebalancing, which involves buying or selling ETFs to maintain your desired asset allocation, can help you stay on track with your long-term goals. Sector rotation, this strategy involves shifting investments between different sectors based on economic or market cycles. For example, during a recession, defensive sectors like utilities or consumer staples tend to perform better, while cyclical sectors like technology or consumer discretionary may do well during periods of economic growth. Risks of ETF investing. Market risk. Like any investment, ETFs are subject to market risk. If the overall market declines, the value of your ETF may decrease, even if the fund is diversified. Tracking error. ETFs aim to replicate the performance of an index, but they may not always do so perfectly. A tracking error occurs when the ETF's returns deviate from the returns of the index it tracks. Liquidity risk. While ETFs are generally liquid, some niche or thematic ETFs may have lower trading volumes, making it difficult to buy or sell shares without affecting the price. Concentration risk. Some ETFs may be highly concentrated in a specific sector or region. While this can lead to higher potential returns, it also increases risk if that sector or region experiences a downturn. How to choose the right ETF. When selecting an ETF, it's important to consider several factors. Expense ratio. This is the annual fee the ETF charges to cover operating expenses. A lower expense ratio means more of your investment returns stay in your pocket. Tracking error. Choose ETFs with minimal tracking error to ensure they closely replicate the performance of the index they are designed to track. Liquidity. Higher trading volumes mean that the ETF is more liquid, which can make it easier to buy and sell without impacting the price. Underlying assets. Always review the ETF's holdings to ensure it aligns with your investment goals and risk tolerance. Fund size. Larger ETFs tend to be more stable and less prone to liquidity risks, while smaller ETFs may face challenges in maintaining operations. The role of ETFs in a diversified portfolio. ETFs can play a key role in building a diversified portfolio. By combining stock ETFs, bond ETFs, and commodity ETFs, investors can create a balanced portfolio that reduces risk and provides exposure to different markets. The wide variety of ETF types also allows investors to tailor their portfolios to specific investment goals, whether it's long-term growth, income generation, or capital preservation. ETF investing offers a simple, flexible, and cost-effective way to diversify your portfolio across a broad range of assets. With the right strategies and an understanding of the potential risks, ETFs can help investors achieve their financial goals while mitigating some of the volatility inherent in the market. Thank you for watching. If you found this video useful, please don't forget to hit like, comment, and subscribe. Also, click the notification bell so you won't miss more videos like this one.